welcome back to another Money Tip Monday. Today I'm going to be pulling back the curtain on all things mortgage interest. I'm going to be talking about the key factors that impact your mortgage rate and then what market movers there are. Like, is it the economy? Is it the president? What is driving mortgage rates up and down? And then that crazy Fed, right? The thing that's always in the news. What is the Fed funds rate and how does it impact you in your personal finance and home ownership goals? Now, before we get into all of that though, guys, I am gonna ask a huge favor. I need you to subscribe and like and comment so that way I know that what I'm putting out to you is actually providing you value in your personal finance goals. So let's jump in, guys, and really talk about if you were doing a mortgage purchase or refinance today, what key factors are actually going to have an impact on your interest rate. And to us as a bank, what we're really looking for is, should we be loaning you money? And if, God forbid, you stop making your payments, right, what would we be doing with this property? How quickly could we sell it? And then would it be at a loss or at a profit? So things that help us determine this are your credit score and credit history. So do you have a long history of making payments on time? Right? Do you have a long history of credit, period, right? Are you a new credit user or somebody who's used it forever? And how much credit is available to you, right? All of these things are really important when it comes to underwriting your home loan and actually have a literal impact on the score that you have. So just note, the better your credit score is, the lower your interest rate. Then we look at how much of a down payment you're putting down or how much equity you have in your property. And equity is, guys, just the difference between your loan amount and what your property is worth today, right? But the more equity you have in a property, the larger the down payment, typically the lower the interest rate. Now, the only caveat here is that loans with mortgage insurance typically have lower interest rates because the risk is lowered for the bank. Because if, God forbid, you defaulted, we would have an insurance policy to help pay us back for some of the loss, right? So they're gonna reward you for having additional insurance. Now, this typically goes away when you're putting 25% or more down, right? But I just want you guys to know, if you're ever wondering why sometimes government-backed loans or loans with mortgage insurance have lower interest rates, right? That's why. Now, those loans don't have lower payments because they have additional mortgage insurance, but it is something to pay attention to. The next thing is occupancy. So it's what you're doing with the property. Are you gonna live there? Is this a vacation home? Is this an investment property? Typically people will, like in hard times, dump their vacation homes or dump their investment properties, right? Because they're additional properties. Owning your property, living there is a lower risk factor for banks. So if you're occupying, you're gonna get a lower interest rate. So then there's loan types, guys. There's all different types of loans: conventional, government, FHA, VA, USDA, jumbo, portfolio, construction. I mean, you name it. If you're adding a risk factor like borrowing more than your purchase price, which is the case in a construction or renovation loan, or if you are taking out equity in the case of a refinance for cash out, right? If you're adding a risk layer, your interest rate's gonna go up. If you're removing risk layers like making your payments more affordable, right, your interest rate's gonna go down. So you just wanna pay attention to that. And lastly, guys, there is also property type. So some properties are easier to sell than others, and you're really gonna wanna advise a real estate agent about this, but anything that makes it harder to sell, like condos with, CC&Rs and restrictions, or manufactured properties with engineer certs, or anything that can add an additional requirement for sale is typically gonna add additional risk factors to your home loan, which makes your interest rate go up. So one thing to know if you're in the market right now and shopping a mortgage loan is that yes, interest rates will vary between lender to lender, but you really want to pay attention to mortgage fees and things called discount points, because you can opt in to buying down your rate. And a lot of the interest rates that you'll see reflected online, all of those things are advertisements, and they will include things like a discount point and be at your best case pricing scenario. So you just want to be aware of that, and that's why it's so important to pay attention to APRs and fees. So now that we've talked about what you personally can do to impact your mortgage rate, I think it's equally as important to understand how the market works as it relates to mortgage rates. So one really important thing to note, well, I guess a couple of really important things to note, is that mortgages are not directly attached to the stock market and or the bond market. And that's probably confusing because you hear people like me talk about the bond market and financial advisors talk about the stock market's impact on mortgages. And then you throw in the media talking about what the heck the Fed funds rate is and the Fed's dropping rates or the Fed's increasing rates. And so it's super, super confusing. So I'm gonna do my very, very best to give you the simplest explanation. So I think it's really important to understand first and foremost what the heck the Feds are raising or dropping. I hear this all the time. Well, the Fed just increased rates or the Fed just dropped rates. And people think that that's a direct correlation to mortgage rates. And I think that the obstacle here is that they don't actually know what the Fed funds rate is. And that's the rate that banks borrow money from the Federal Reserve. So when interest rates drop for banks, the idea is that there'll be more liquidity for businesses to invest or to loan out or, to be more profitable. And so typically we see a direct correlation with more liquidity in stock market rallies. And this actually has an adverse effect on interest rates, right? So if the stock market is rallying, people or investors actually are taking their money out of the bond market, right? And when they do that, there's actually an adverse relationship for interest rates. Now, the reason it gets super confusing is because then the normal person would attach mortgage interest rates to bond rates. And while there is definitely a parallel, mortgage rates are actually attached to mortgage-backed securities. And the reason that they have a parallel with treasury bonds is because they attract the same type of investors. The reason for that is because there is a high probability of them paying back. Treasury bonds are guaranteed payback. Mortgage-backed securities are actually fairly secure too. There is higher risk though because of defaults like I talked about earlier. But generally speaking, these types of investments have guaranteed paybacks or more secured paybacks. So now when the Fed actually increases their rate, typically they're pulling back on liquidity. And we normally see the stock market decline because as things become more expensive or there isn't as much liquidity available, right, the stock market tends to decline. When you see the stock market decline, right, because of an economic event or because of a natural disaster or because of global economic issues, right, typically we see investors that would normally place their money in the stock market move their money over to bonds and mortgage-backed securities. And so that's why there is a correlation with what's happening with mortgage rates. So it is not a perfect system, but if you were somebody that was interested in knowing when it's a good time to lock, this is something that I would pay attention to. So I know that this is really confusing stuff, guys. This is like a tornado of if this, then that. Right? But essentially, like stock market rallies are not good for mortgage interest rates. And then bad economic news, crazy presidents, global trade wars like this tariff situation in China are typically good for interest rates, right? When you're trying to lock in your home loan, right? So just think of it as the opposite, right? So don't look at your 401k if you're rallying for your mortgage interest rate. Now, I know we talked about a lot of things, guys, what you can do to personally impact your interest rate, and I did my very best job trying to explain our mortgage market tornado. But if you have more detailed questions or you just want to know what my personal opinion is on what's going to impact our mortgage interest rates this week, you can sign up for our Monday market email at lizyhoeffer.com. That'll be in the show notes. It would be my honor to provide you with this information. And if you have more detailed questions, do not hesitate to comment below, subscribe, message me, DM me, shoot me an email, a text message, I'm available. I'd be happy to help you guys. Until next time, thank you so much. I will see you soon.